If you were to draw a map of the global economy back in the early 2000s, the borders were pretty well defined.
Right, very rigid.
Yeah, and sovereign nations were basically the undisputed financial giants. But I remember when Apple became the first public company in history to hit a $1 trillion market cap. That was August of 2018.
Oh, yeah, I remember that.
It felt like someone breaking the 4-minute mile, you know?
Sure.
Financial models basically had to be rewritten because a corporate valuation with 12-digit number attached to it just, well, it seemed impossible to sustain.
It was a psychological barrier more than anything.
Base.
I mean, we were so conditioned to measuring corporate success in the billions, right? So a trillion felt like this threshold reserved for the GDP of an entire country.
Right.
But once that barrier was broken, it really recalibrated how investors view scalability.
And it certainly opened the floodgates. Because if
Yeah.
you fast forward to our current reality here in mid-2026, that mythical $1 trillion continent is, well, it's starting to look awfully crowded.
Very crowded.
We are living in a world where there are now 16 companies worth over $1 trillion. 16.
It's staggering.
And the sheer scale at the very top is just, it's difficult to wrap your head around. I mean, NVIDIA is leading the entire world at an astonishing $4.7 trillion.
Yeah.
Apple sits right behind them at $4.2 trillion. Microsoft is at $3.8 trillion, and Alphabet is at $3.08 trillion.
Which really tells us that wealth concentration at the absolute top of the market has accelerated far beyond what typical growth models predicted.
For sure.
We aren't just seeing companies getting larger. We are seeing the infrastructure of the internet and artificial intelligence consolidate into, a handful of mega corporations.
And that consolidation brings us perfectly to the focus of today's deep dive. We are looking at this incredibly timely financial analysis titled "The Next Trillion-Dollar Company, Wall Street, is Already Betting on These Four."
It's a fascinating read.
It really is. And our mission today for you listening is to look past the noisy, chaotic daily stock tickers and understand the foundational trends that Wall Street is quietly betting massive amounts of capital on. So, okay, let's unpack this because deciphering Wall Street's playbook here feels like trying to read the blueprints for the next decade of human history.
Reading the blueprints is actually the perfect way to frame it. It's really vital for you, the listener, to remember that crossing the $1 trillion threshold isn't simply a matter of a company having a good sales quarter.
Right, or like slightly optimizing their supply chain.
Exactly. It's a symptom of a company fundamentally altering human behavior or rewriting global infrastructure. You don't reach $1 trillion by just participating in a market.
You have to own it.
You get there by becoming the foundation that a new market is built upon.
So let's apply that logic to our first candidate. Since NVIDIA is the $4.7 trillion gorilla in the room dictating the AI boom, it makes sense to start by looking at who is riding that exact same wave, but, maybe attacking it from a different angle.
Right.
The source points us straight to AMD. They are currently sitting at an $800 billion market cap.
Which is getting close?
Very close. It puts them just $200 billion shy of joining the club. And their data from Q1 of 2026 is, it's practically jumping off the page.
Oh, absolutely.
Their data center revenue jumped 57% year over year. That's hitting $5.8 billion in a single quarter.
And you have to understand, moving the needle 57% at that specific scale in the semiconductor space, that requires a structural shift in global demand.
Yeah.
But to understand why Wall Street is so bullish on AMD closing that $200 billion gap, we really have to look at the architecture of AI itself. Artificial intelligence requires two distinct types of processing power to function efficiently.
And the source breaks this down beautifully. NVIDIA built its multi-trillion-dollar empire essentially by perfecting one core component, right? The GPU, or graphics processing unit. For anyone listening who isn't a computer engineer, think of a GPU as the heavy lifter. It can perform thousands of simple calculations simultaneously, which is exactly what you need to train an AI model.
Right, it's the muscle.
NVIDIA built a spectacular engine there, but AMD is flying a twin-engine plane.
And that twin-engine strategy is their true differentiator. While they are building GPUs to compete directly with NVIDIA, their other engine is the CPU, the central processing unit.
Like the manager of the system.
Precisely. The CPU tells the system what to do and when to do it. AMD's EPYC server CPUs are already deeply entrenched inside the data centers of the biggest cloud providers on Earth.
We're talking places like AWS, Google Cloud, Microsoft Azure.
Exactly. And these cloud providers cannot easily rip out and replace their foundational CPUs. It's too embedded.
Right.
So AMD has this incredibly sticky, guaranteed revenue stream from their CPUs while simultaneously launching their Instinct GPUs as the credible #2 AI accelerator behind NVIDIA.
They're basically squeezing the AI infrastructure build-out from both sides, the management side and the heavy lifting side.
Yes, exactly.
And when you have a core business growing at 57%, a $200 billion gap to reach 1 trillion isn't some, vast chasm. It's just the next logical milestone.
Very achievable.
The analysis actually notes that if their current hardware adoption holds, they could easily cross the threshold within 18 months.
Wow.
But hardware is only half the AI equation, which leads to the bonus company mentioned in the report, Palantir.
Yes.
Now, they're sitting at a $330 billion market cap. That is a massive leap required to hit a trillion.
What's fascinating here is how quickly the market can reprice a company when a bottleneck is suddenly solved. To really understand Palantir's potential, the source draws a direct comparison to Micron.
Oh, that's a great comparison.
It is. Earlier this decade, Micron jumped from a $500 billion valuation to $1 trillion in a span of just 48 days.
48 days. I remember reading that and having to check the math.
It's wild.
Doubling a $500 billion company in a month and a half breaks every traditional rule of market momentum.
It breaks the rules until you look at the underlying mechanism. See, Micron didn't just sell more of their standard product. They manufacture high bandwidth memory, or HBM,
Right.
AI GPUs, like the ones NVIDIA and AMD make. They are incredibly fast, but they're absolutely useless if they can't access data quickly enough.
They were starving for data.
Exactly, they were starving. Micron created the memory chips that solved that exact bottleneck, allowing the AI chips to run at full capacity. The market instantly realized Micron was the missing puzzle piece for the entire AI industry, and, well, they priced them accordingly.
Which brings us back to Palantir. If AMD and NVIDIA are providing the processing power and Micron provides the memory, Palantir provides the software layer.
Right.
They are the AI data analytics platform utilized by virtually every single U.S. government agency, and increasingly by Fortune 500 companies, too.
Yeah, their adoption is spreading.
As raw computing power scales up, the amount of data being generated is growing exponentially. Palantir's software is the tool used to actually make sense of that data mountain.
Exactly.
So they're a long shot mathematically to hit a trillion soon, but structurally, they are positioned at the exact bottleneck of software interpretation.
And the transition from processing data to interpreting it is where the highest profit margins live.
Speaking of profit margins, let's completely pivot away from Silicon Valley server farms. I want to shift our focus to something incredibly familiar to our listeners.
Okay.
A company that feels like the ultimate old economy staple, Walmart.
Placing a brick-and-mortar retailer next to high-tech AI firms creates a brilliant contrast.
It really does.
It proves that massive trillion-dollar innovation can happen in retail aisles and logistics centers, not just in laboratories.
Yes, but I do have to push back on the framing our source uses here because I was genuinely confused when reading this section.
Oh, so?
Well, the report confirms that Walmart actually crossed the $1.1 trillion line in 2026. Back in May of this year, they officially replaced Eli Lilly among the top 10 largest companies in the Russell 3000 index.
Right, they did.
So, if they are already past the finish line, why are they featured in an analysis about the next trillion-dollar companies? Why are analysts projecting them to surge to 1.5 trillion in 3 years? What is Wall Street seeing that, everyday shoppers pushing carts down the cereal aisle just aren't seeing?
Well, the shoppers in the physical aisles aren't the ones driving this new valuation.
Right.
The analysts are looking exclusively at what's happening behind the glass of your smartphone. Walmart's e-commerce sales jumped 27% year over year.
Wow.
And their subscription service, Walmart Plus, is functioning very much like Amazon Prime, basically locking in customer loyalty. But the secret engine driving that $1.5 trillion projection is retail media.
Retail media. We hear that term thrown around a lot in marketing circles, but explain the actual mechanism of how that generates trillion-dollar valuations.
It comes down to monetizing digital real estate. Walmart has quietly built one of the most powerful advertising networks in the United States, directly on Walmart.com and their mobile app.
Okay.
If you're listening to this and you've searched for, say, a specific brand of toothpaste on the Walmart app recently, you've participated in this ecosystem.
Right. You see those sponsored results.
Exactly. Brands are paying top dollar, essentially entering bidding wars, to ensure their toothpaste appears at the very top of your search results.
So it is the exact same concept as buying the top sponsored spot on a Google search, but applied at the exact moment a consumer has their wallet out ready to buy.
Yes. And the economics of that are staggering. Think about the traditional Walmart business model. Selling a physical gallon of milk involves incredibly tight margins.
You have to pay the farmer, pay for refrigerated transport, pay the stockers, and account for spoilage.
Exactly. The profit on that milk is pennies. Right. But selling a digital ad placement, once the software infrastructure is built, selling pixels on a screen is almost pure profit. Walmart is executing the exact same high-margin advertising playbook that Amazon utilized 5 years ago.
That's wild.
They are no longer just a retailer. They are an advertising platform with a captive audience of millions of daily buyers.
That completely reframes how you look at the company. A physical retailer utilizing their massive footprint to fund a hyper-profitable digital ad network.
Yeah.
But if Walmart shows us that legacy retailers can learn new, high-margin tech tricks, our next candidate demonstrates how legacy holding companies can completely weaponize their balance sheets.
Oh, definitely.
Let's talk about Berkshire Hathaway.
A company historically synonymous with patient conservative value investing.
Yeah, currently sitting at a $1.1 trillion market cap. And let's remind the listener of the sheer mass of this conglomerate. They fully own Giaco, BNSF Railway, Dairy Queen, and See's Candies.
Plus, they hold massive market-moving stakes in Apple, Coca-Cola, Bank of America, and American Express.
Their portfolio is essentially a cross-section of the American consumer economy.
It really is.
But here's where it gets really interesting, though. Warren Buffett officially retired at the end of 2025.
Yes.
That represents a tectonic shift in the psychology of the financial world. For decades, Berkshire was defined by his specific philosophy. Now, Greg Abel is the CEO, and our source characterizes his approach to capital deployment as, well, decidedly more aggressive.
Oh, we have to look at the ammunition he has to work with.
Okay.
Berkshire is currently sitting on a cash pile of $320 billion.
Just to contextualize that for you listening, $320 billion in liquid cash is larger than the entire market cap of most Fortune 500 companies.
It is a staggering amount of capital.
Hmm.
But we shouldn't view that cash as a sleeping giant waiting to wake up. In the current economic climate, that cash is dry powder.
Right.
In a high-interest rate environment, holding that much capital gives a company immense leverage. Tech companies and startups are burning through cash, struggling to secure cheap loans. Berkshire doesn't need a loan. A new, more aggressive CEO isn't going to let $320 billion sit around earning basic treasury yields
So
indefinitely.
he's going to go shopping.
Oh, he has the capacity to swallow entire industries whole. One single massive acquisition, perhaps buying a struggling tech giant outright or taking a massive stake in future energy infrastructure, could easily catapult this holding company well above the $1.5 trillion mark.
Wow.
The infrastructure is already there, making Berkshire arguably the safest bet on this entire list, while the unknown variable of Greg Abel's first massive acquisition makes them an incredibly exciting wildcard.
It is the ultimate flex of financial gravity. They have enough mass to pull whatever they want into their orbit.
Exactly.
All right, so we've explored tech hardware scaling through CPUs and GPUs, retail algorithms generating pure profit, and massive financial acquisitions waiting in the wings. But the most explosive financial metrics in our entire source document belong to an industry that has nothing to do with silicon or digital advertising.
Right.
It's focused on the optimization of the human body itself.
The biological revolution is arguably the most tangible trend on this list for the average person.
Our fourth candidate is Eli Lilly, a pharmaceutical company sitting at $962 billion. They need a measly 4% growth bump to cross $1 trillion.
Just 4%.
And when you look at their Q1 2026 earnings, I mean, the numbers frankly look like a typo. Listen to these stats. $19.8 billion in quarterly revenue, which is a 56% jump.
Huge.
Earnings per share came in at $8.55, beating Wall Street estimates by nearly 26%. And the statistic that completely blew my mind, net income, grew an incomprehensible 168% year over year.
Let's dissect that for a second. How net income, actual profit, can grow by 168% when revenue only grew by 56%.
Yeah, how does that work?
It comes down to the mechanics of pharmaceutical scaling.
Right.
When Eli Lilly develops a new drug, the research and development costs are astronomical. It costs billions just to get FDA approval.
Right.
But once that drug is approved, the cost to manufacture each individual vial is relatively low.
Ah, so the R&D is a sunk cost.
Exactly. So as they scale up manufacturing to meet global demand, their fixed costs remain stable while their revenue skyrockets. That dynamic leads to massive margin expansion, which is why profit outpaced revenue so aggressively.
And we know exactly what products are driving this global demand. It's Mounjaro for diabetes and Zepbound for obesity.
Yes,
Our source notes that these two drugs alone generated $36.5 billion dollars in 2025. They have essentially created the most valuable drug franchise in medical history.
it's unprecedented.
For our listeners who might not be familiar with the science, these are GLP-1 drugs. They basically mimic a hormone in your body that tells your brain you are full, while simultaneously slowing down digestion. It completely alters a person's relationship with food.
It is a profound medical breakthrough, but what they have achieved so far is merely the prelude.
Really?
If we connect this to the bigger picture, the true catalyst pushing them toward the trillion-dollar mark and far beyond is the recent FDA approval for their new drug, Foundayo.
Oh, the oral version.
Yes. The transition from an injection to a daily pill changes the entire economic model of the treatment.
How so?
Think about the friction involved with an injectable medication. It requires a certain level of psychological commitment from the patient. It can cause anxiety, and from a logistical standpoint, injections often require cold chain shipping,
Right, meaning they have to be refrigerated from the factory all the way to your refrigerator.
which is incredibly expensive and limits global distribution.
Right.
But a pill can sit in a plastic bottle on a pharmacy shelf at room temperature for months.
Wow.
It takes a medical procedure and turns it into a daily vitamin routine. It instantly removes the psychological friction for hundreds of millions of injection-averse patients worldwide, while simultaneously slashing shipping and storage costs for the company.
So the profit margins expand even further.
Exactly. The financial projections align perfectly with that reality. Analysts at TD Cowen are projecting that Eli Lilly will capture 62% of the $150 billion GLP-1 drug market by 2030.
That is massive.
Given their current trajectory, it is a near certainty they will push well past the $1 trillion market cap by the end of this year.
The company manufacturing the world's most effective weight loss solution is about to become as valuable as the companies building the internet.
It's a new era.
It really is. When you step back and look at these four distinct pillars we've covered today, a unified theme emerges. Whether it's AMD chasing down a $200 billion gap by providing the dual-engine processing power for AI, Eli Lilly removing the friction from a global pharmaceutical revolution, Walmart weaponizing its physical retail dominance to become a high-margin digital ad giant, or Berkshire Hathaway sitting on a $320 billion war chest ready to acquire the future. I mean, none of them are succeeding by accident.
No, they share a common DNA. The core thesis from our source material is that every single company that has ever sustained a $1 trillion valuation did so by recognizing a massive structural trend and building the foundation for it before the broader public understood the scale. Apple did it with mobile internet via the smartphone.
Yeah.
Amazon did it with digital commerce logistics. NVIDIA did it with parallel processing for AI.
They don't just surf the wave, they essentially alter the gravitational pull of the ocean to create the wave in the first place.
Which means the challenge for anyone observing the market isn't just trying to guess which specific stock ticker will cross a numerical threshold next.
Right.
The much deeper question you have to ask yourself is, which of these foundational changes in human behavior do you actually believe in? Do you believe AI software will interpret all global data? Do you believe retail media will overtake traditional advertising? Do you believe biological optimization will become as common as taking an aspirin?
So what does this all mean? We've spent this entire deep dive talking about $1 trillion, like it's the ultimate finish line. But let me leave you with a completely different concept to mull over before we go. If single isolated trends like AI processing, retail media, and obesity medication are powerful enough to create $1 trillion companies today, what happens when these massive parallel sectors inevitably begin to collide?
Well, that's an interesting thought.
Just imagine a near future scenario where the AI data analytics power of a Palantir is acquired by a massive holding company like Berkshire Hathaway. And they use that predictive software specifically to optimize the complex global supply chains of biological breakthroughs like Eli Lilly's GLP-1 pills.
Wow.
And then they distribute those high margin products through the ultra efficient, advertising driven retail networks of Walmart. The first $10 trillion company in human history probably won't just dominate one single trend. It will likely be the organization that figures out how to successfully merge them all together.
It always returns to our starting premise. It's about altering infrastructure. The companies that figure out how to weave those different infrastructures together will define the map for the next century.
And the borders of that new map are being drawn right in front of us every single day. Thank you so much for joining us on this deep dive. Keep questioning the trends around you, keep looking for the why behind the data. And remember, just because a new financial continent hasn't been discovered yet doesn't mean it's impossible to reach. We'll see you next time.